welcome to another Loan with Jen podcast. We're on YouTube. We're up, whether you're listening to us or watching us, welcome. Real facts, no BS, everything about mortgage. Today we are here with Alex Massa of Appraisal MC. Alex has been doing appraisals for us for, God, a dozen years? More than that.
Maybe more.
Maybe a little bit more. So he's in the local Houston market, and today we are talking about home values, specifically in Houston, Texas. It will permeate to other parts of Texas. But if you're in Houston or surrounding areas, you definitely want to hear this episode. So we're in January 2023. Alex, thank you for being here, by the way.
Happy New Year.
I really appreciate it. Yeah, Happy New Year. So we're talking specifically about Houston. You've got the pulse. I know we chatted a few minutes before we started. So we're going to just get some negative stuff out of the way first, because I like to talk about positive things. But some markets are declining. So tell us about that. Tell us which areas of Houston or price points are being affected by the downturn.
Yeah, so let's talk about price points, because I think that's where you see the differentiation on price decreases. So really, you have such a large market that's looking at homes under $500,000. So I would say 70% of home buyers are in a market that are looking below that. Means majority of the market share is there. You've got a lot of demand there still. So really the slower markets, or the markets where days on markets are increasing or values might be stabilizing or decreasing, are really the price points over $500,000.
Okay.
So, you've got, Houston has no zoning. So you've got a hodgepodge of areas that are over $500,000 all over the city, especially central to west, and I think those areas are the ones. I wouldn't say that they're suffering, but they're the ones where you can significantly see price points are getting a little bit depressed, or days on market are increasing. Yeah.
So just let's rewind a minute. 2021 showed us. I mean, days on market was about 2, literally.
Yeah.
And so now, in these, let's talk about the over 500,000, the ones that we're starting to see a decline.
Right.
Are you seeing days on market go to about, if you could guess on average, I know different areas might be a little bit different, but what are they?
Yeah, they're increasing. They're at 3 to 4 months, let's say.
Okay.
Yeah. Which
is still a semi-seller's market. They say 6 months is
100%.
Balanced.
Yeah.
Okay.
They say 6 months is balanced, but since 2011, 2012, everything has been under 3 months. So anything over 3 months feels really slow, or like an oversupply. Correct.
So are you seeing values from appraised values of what market value is? You're seeing them go a little bit backwards?
This is what's very tricky. So when you do an appraisal, you're looking at past data.
Okay.
The past data is still good. What we're seeing is the contract prices are coming in above contract price, but they're lower than what we can appraise it for, because we're using past data. So what I'm thinking is happening is they don't have buyers, they're taking lower offers, and the closings we have today are what's going to depress the comps for the next few months.
Tomorrow.
Exactly.
That's pretty good intel right there. That was amazing. Right. Okay. So now I did hear, so I've got some realtor friends that said in West University, which is always, it's close to the med center, close to everything.
Yeah.
They're like, we can't keep houses on the market in here. Is that true?
It's
West
true.
West
yeah,
U
West U's still hot. There's still a few markets that are hot.
So in the upper end, which markets would you say are hot?
Memorial, if you look at Memorial, price point under 2 million, still hot.
Okay.
West U, price point under 2, really under 1.8. Bel Air, under 800. Now the stuff in Bel Air over 800 is starting to see a bit of a decline, or a little bit more depressed. All those areas have something in common. They are all zoned to really good school districts, right?
Yeah.
So
that's the key.
It seems to be the key to the location.
So what about upper end over the 500 in like the burbs? Like I live in Katy, and so there's, it's easy to find a $600,000, $700,000, $800,000 house out there now.
Yeah.
Seven Lakes. I mean, they're
everywhere.
600, 700. Yeah.
So you've got inventory increasing. You've got builders that got ahead of themselves.
Okay.
And started building specs, thinking, oh, we'll get these sold no problem. They're sitting on the market.
And they're sitting.
You're competing against that. And then on top of that, you have people that went under contract for new construction a year ago that may not be able to afford that today with today's interest rates.
Yeah.
So those contracts are canceling and they're going back on the market. So the suburbs in that price point really starting to see, not a glut, but you're starting to see the inventory start to grow.
So I'm going to take a segue here, and we're going to get back to, now we're going to talk about the markets that are thriving. But I do want to make a mention. You said that people that got under contract a year ago might not be able to afford. So whether it's new construction or resale, talk to your lender. If it's not me, I would love to be your lender, but I may not be, about a buy down. So you can use a seller credit, and we're going to go deeper in seller concessions towards the end. We already kind of mapped that info out, but you can use a seller credit to buy down the rate. So we're going to talk about that a little bit deeper towards the end. So FYI, sidebar.
Absolutely.
So let's talk about the thriving market. So would that be things under 500,000?
Things under 500,000 in good locations. One of the key factors for good locations in Houston, especially in the burbs, is being zoned to a good school district.
Okay. Katy,
Cypress, Fulshire.
Spring is good.
Even Pearland, Friendswood,
Yeah,
Spring,
all
Woodland.
of it.
So
The burbs.
In the burbs, yeah. That's why people move out there, raise children, and send them to good schools. So.
Okay. Cool. So what about, the price point of the below 250? We've got a lot of buyers that all they can afford, especially when people are leaving the rental community. A lot of people want an $1,800 or a $2,000 a month payment.
Exactly.
And that's a 220, let's say just below 250 house. So how is that market doing?
Very, very competitive. And I'll tell you why, is because you're competing against investors that are thinking the same thing, that there are a lot of people out there that may not be able to afford payments, but they're able to afford renting a house. So you've got big buyers from hedge funds to, more smaller local funds to individual investors trying to gobble up that market share, in the anticipation that rents are going to continue going up. Now, I saw a report today where rents are actually going down.
Oh, wow.
Nationwide, they were down 3%. But if you drive around the burbs, you're starting to see single-family construction slow down, multifamily construction start to increase. I think what's happening is people are having a difficult time in some markets maybe selling property, so they're putting them on the market to rent. So that's increasing the pool of rentals right now, which will, in that instance, lower the cost of renting a home.
Interesting.
Yeah.
That's
so
really
many weird
interesting.
dynamics. And
Yeah.
one thing I've always said is appraisers are, they're experts at predicting the past. Never would I have predicted in a market like this. I was expecting rental rates to just continue, but with more inventory being pulled off the market for sale and going back into the rental pool, now I see how that dip could happen on the rental rates.
Well, let's face it though, this needed to happen. This could not, 2021, it was fun for about a month. And then I was like, okay, it was too much.
It was too much.
The inflation, and that's why the interest rates, that's why the Fed started choking, let's call it choking the economy, for this exact reason. This is supposed to happen.
Right.
And as inflation comes down, y'all, rates will start to come down. So as things become more affordable, so that's good news. We'll talk about that in a minute on some good news, what we foresee. But so thriving markets, really anything under 500,000, which is that's more thriving.
In certain market areas.
Yeah.
Right? We talked about the burbs. Now you look inside the city, townhomes, patio homes under 500,000. That's more of that's an oversupplied market. You had a lot of inventory planned over the last couple of years. The market was hot. You had a lot of developers jumping in, and now it's gotten really competitive.
Okay.
And interest rates affect the monthly payment, so you've got less potential buyers for those types of properties.
That is true. So days on the market in these lower price range areas, like you said, let's talk about the burbs first, and then we'll do inner city. So average.
In the lower lower price point market areas, I'm still seeing under a month on
wow.
days on market. Yeah.
In the 300, 400, 500,000.
Absolutely. If it's a competitive market, a well-kept home, it's still under a month.
Okay. And in the inner city stuff, the inventory, it's the 3-4 months maybe that you're seeing?
It really depends on the particular market area. You know, some markets are still semi-hot, like the Heights. But I can see Montrose's volume and days on market increasing to maybe 2 to 3 months for townhome, patio home, condo style living. So
so let's talk. We'll talk more about. We're going to talk about seller concessions that are some solutions. I know. Let's talk about that.
Yeah.
And then we're going to talk about what we're going to foresee. So we've got some good stuff to come. So seller concessions. So I like to try to make things simple. So a seller concession is where the seller gives a credit. Now there are some limits. I'm going to put in the notes of the description of whether it's a podcast or video that you're watching. I'll put the link to seller closing cost credit limits so that you can watch that another time. So as long as you're within the limits, I mean, if you're paying cash, there's no limit, but as long as you're within the max limits that the lender will allow, a seller credit can be one of 3 things. It can just go towards flatline closing costs, just reduce your cash to close. Or the second way is it can permanently reduce the interest rate. So let's say the rate, I'm just making this up, but let's say it was 6.5 and you could pay about 1% of the loan amount. So let's say the loan amount's $400,000, you pay $4,000. It would buy it down probably to 6.1. Okay, so that's the math. Now you can pay more to buy further, but that $4,000 of that upfront one-time fee, you can negotiate with the seller to pay that.
That's
okay.
Great.
So they could pay $4,000, they could pay $8,000. $4,000 can go to buy it down, and the other $4,000 can go to another closing cost. You know, just normal closing costs.
Title, insurance, whatever.
Yeah, anything. Can it be applied to any of those things? Now the third way, and it's a little bit more expensive for the seller, and it's equivalent to about 2.5% of the loan amount. So if it's a $100,000 loan, this is the math I can do in my head. If it's a $100,000 loan, it's $2,500. Okay, so basically it lowers the interest rate. It's called a 2-1 buy down. It's a temporary buy down, and it buys. Let's say the rate's 6.5. The 2 and the 2-1 buy down means that the first year it's 2% lower. So instead of 6.5, the rate is 4.5. And then the second year, it's 1% lower. So it hops up to 5.5. And then in year 3, it's the fully 6.5 rate. But by then, rates are going to be down, and we're going to be refinancing anyway. But we'll talk about that
Knock on wood.
in a minute.
Yeah.
So that temporary buy down actually saves clients more money in the short term. So again, it has to be paid by the seller. It's a heftier cost. But if you're in an area that's a little bit suppressed, take advantage. We are seeing buyers take advantage of this. Saves borrowers hundreds of dollars on their mortgage payment. And again, it's temporary until such a time when rates do come down. So now that leads me to, we're going to talk about what Alex foresees in the value market, just your crystal ball to your best knowledge, and then I'll talk about interest rates.
I want to jump in on the seller's concessions real quick, because I have a thought on this. While you were talking, my brain was spinning. We've got a window right now, this first quarter, where I believe homes are going to appraise above contract. And that leaves room for sellers' contributions. For example, a year ago, if you were trying to get $10,000 in seller's concessions from the seller and they gave it to you, if the home didn't appraise for that amount, then you would possibly lose those seller's concessions. If it only appraised for $200,000 on a $210,000 sales price, well, you probably will negotiate that seller's concessions out. Well, right now we've got that window where we're looking at past sales. The past sales are a little bit higher, and you can inflate the sales price a little bit and still be supported with past sales in order for sellers' contributions to be given to the buyer. So this is a short window. 3 months from now, with these new sales that are happening, if they're not closing at a certain price and the prices get more depressed, your window of seller's contributions might dwindle a little bit more.
So this is going to be a diamond that I'm about to give everybody who's made it this far. Thank you for listening this far. This is going to hopefully make the whole thing worth it. Did you know that, let's say you're under contract for a certain amount and it comes in higher, that you can go back to the seller and whatever the difference is, say, hey, will you kick that, can you give me that amount in closing cost credit, as long as it doesn't exceed those credit limits, the limits that we talked about, right, that you can watch in that other video that we've got below. So for an example, let's say 400,000. Let's say the price negotiated is 400, and let's say there's no seller's concessions so far. Nothing was negotiated, let's just say. And it comes in at 410, which could happen. It happened to us the other day. It
happens all the time.
That $10,000, you can reapproach the seller and say, can we up the price to 410 and you give us 10,000 in closing costs and we use it to buy down the rate. Now it's important to know that we can do this only because it 100% benefits the buyer. If it benefits the seller in any way, it will not pass, at least when there's a lender involved.
Right.
But it's a really creative way to squeeze a little bit more, use that leverage, and help with closing costs. Whether, I mean, really, whether the buyer needs it or not. I mean, I would take it. Whether I need it, and buy down the rate. Why not?
Buy down the rate, lower,
do a 2-1 buy down.
Whatever costs you have to.
So when the lender tells you that it's appraised for higher, ask them if that can happen, or like, help me do this. We automatically go to our clients about it. But again, I'm not doing every loan in Harris County. I wish I was, but you know, I'm not.
Right.
Realistic. So that's just something for you that's a little bit of a bonus. So what do you foresee, Alex, with values? Let's just talk about 2023.
Let's talk about inventory and values. I think it's a hard pill to swallow for sellers right now, and that they've got to lower the price on their homes in order to move it. So what we're going to end up seeing is, as inventory increases, as days on market increase, the sellers will start getting a little bit more desperate, and that's when prices will come down to where buyers and sellers can meet. I think we're back to our seasonal trends. We've been in the industry, both of us, for more than 2 decades, and the seasonal trends are, hey, January, February are slow. You start seeing the uptick in March. We're back to that. And I think on top of that, right now is going to be a good opportunity in the next 2 months for buyers to pick up homes at prices that are more reasonable to them. And don't worry about the rate. Like Jen is saying, we both think rates are going to come down. I'll spare you I'll give you the floor on that. You'll be able to refi at some point. So.
Yeah, thank you. I actually just made a video yesterday about why rates don't matter. So, but what I foresee from the rate perspective, and this is all stuff that I've been reading, there's economists that I'm listening to, you know, I'm definitely diving into all of that, is that within 12 to 18 months, the rates will come down. Right. And there's prediction that we'll see the 4s again. I really don't think we'll see the 3s. That was falsified because the US was buying its own debt.
Right.
I mean, that was manipulated 100%, but that could happen in the future, but I wouldn't bank on it. But right now, people that are getting something with rates in the 6s or the 7s, if it gets into even in the 5s, right? Like you'll be saved, depending on your loan amount, you'll be able to save quite a bit of money. So that's number one. I do foresee, as inflation starts to come down, the rates will come down. It's a historic fact. Like you look back on interest rates over the last, in fact, we're going to put that graph, we'll put a link to that graph in the notes, the show notes of this description as well. So that's what I foresee. I see a lot of refinance in the future, and that's why, you know, lenders, a lot of the rates are staying a little bit high, or you're starting to see points on loans because they know that they're going to have early payoff, y'all. Like if you're an investor, you cannot get an investor loan with without paying 2 points up front because they know that you're going to pay them off. They know. Now, homeowners can when it's a primary residence, but you know, the market's a little fickle right now because they know that the payoff is coming in 2 years. So they're like, well, we got to get our fees up front. Yep. So that's what I foresee. I really appreciate you coming in today.
My pleasure. I'm glad to share some knowledge. I don't have a crystal ball, and neither do you, but we're optimistic. One last thing I do want to mention, we're talking about Houston, and our company services 39 states, so we see a lot of markets. We didn't see the huge increases that other markets saw, so I don't foresee us seeing huge decreases in values like other markets. There's no better place to buy a home, keep a home than Houston, Texas. So I'm just glad we're based out of here. Yeah, that is true. And for those of you, whether you're a buyer or a seller that's listening or a realtor, I will put Appraisal MC's info down if you need a measure of a house, or if I was selling my house right now, I would get an appraisal prior to listing it. I would for sure, so that I knew what to expect. So a local appraiser can definitely help you with that. Alex, thank you so much. Thanks, Jen. Yeah. Viewers, listeners, thank you for tuning in. Real Facts, No BS. Loan with Jen, out.